Today, you're going to learn the number one biggest investing mistake retirees make and the two-step framework smart retirees use to avoid that big mistake. Welcome to Retire Today. I'm your host, Jeremy Keil, and we're here to help you create your dream retirement. Today, we're talking about how to create your retirement investment plan. Your retirement investments are part of your planning towards retirement. I detail the 5 steps you need to take in creating a retirement plan in my book, Retire Today. We've been going through those 5 steps, and we're on step 4, which is creating your retirement investment plan. And I think a lot of times when you're focusing on your investing, you can get overly focused on your investing. It leads to a lot of mistakes. I've seen a lot of people make a lot of mistakes with their retirement investing. If I had to sum up how they make all these mistakes, that number one way that they make all mistakes, kind of everything flows into this. It flows into the biggest investing mistake people make, and that is trying to control things you can't control. So I'm going to talk through how do you avoid that number one investment mistake? How do you avoid trying to control things you can't control? Part of it is going through the right framework when it comes to your investing. So we've gone through the initial steps. You figured out how much do you need to spend or want to spend in retirement. You figured out how do you make more from your Social Security, especially, but from your lifetime income sources. How do you keep more of your investing? Keep more of your money in retirement by proactive tax planning. Here we are figuring out your retirement investing. And I think it all starts with understanding what is the goal of your retirement investing. I think the goal of your retirement investment plan is not to pick the best stocks. It's not to try to beat the market. That's what most people are trying to do. They're trying to get this magic bullet. We've had just some people recently who are complaining that the stock market, their investments are only up 10% for the year. And can they try to get a little bit more? And when we dug into it, they're really kind of looking to get a magic bullet to say, I'm overspending. And if only I could just pick the next hot stock, then I can keep on with my overspending. When really the problem is not their investments. The problem is their spending. That's the problem, though. A lot of people are trying to come out ahead, trying to just create magic out of thin air. What they've been doing is they're trying to control things they can't control. You can't control what the stock market does. You can control a bit of the risk you take within the stock market. So as you approach your investing with retirement, I want you to focus on the 2 main levers, the 2 things you can pull, your big decisions about retirement. The first is how much money do you keep out of the stock market? And when you keep money out of the stock market, it's maybe more towards short-term income type investments. The second thing you can control, your part 2 of your retirement investing, is how much risk do you take within the stock market, up or down? You can't control what the stock market does, but you can control the level of risk you're taking in the stock market, mainly through the amount of stocks you invest in, the percentage of stocks in your portfolio, and have you diversified that well? If you've heard this before, it's really like a bucket strategy. I've got a picture graphic in the book, and I'll have it in the show notes as well. What the bucket strategy is saying is don't view your investments like this big portfolio. Think of it for 2 purposes. Your short-term money, you could call that the income bucket, and your long-term money, you could call that the growth bucket. And money you need in the short term, you ought to invest in short-term investments. Money you need in the long term, you ought to invest in long-term type investments. So stop viewing your portfolio, your investments, like just one thing. View it as in 2 things with 2 different purposes, 2 different ways that you invest your money. Now, a question you might have is, how much should I put money in the short-term bucket? How much should I put there? How much money should I put in the long-term bucket? Well, let's look first at the short-term bucket. The whole point of the short-term bucket is to meet your upcoming cash flow needs. You need to take money out this year, next year. You're saving to do something a couple of years from now. This is money that you can't rely on the stock market for. The stock market goes up and down over time. I've seen studies that show that in the past, doesn't mean it'll happen in the future, but in the past, the market's up 70% of the years, right? So you look at today, 1 year from now, 70% of the time, the market is up. So if you're deciding you need money out, say 1 year from now, do you want to rely on something that would be down 30% of the time? You might not. You might want to rely on something that's up 100% of the time. Things like bank type money. Now, for that safety, for that guarantee, it hardly gives you an interest rate at all. Thankfully, a better interest rate now in 2025 and the last couple of years. But the money you're relying on in the short term, that's where you find your short-term investments. That's called the income bucket. Hi, it's Jeremy Keil here, and I know you're listening to the Retire Today podcast because you would like to create your dream retirement. I created a free video course to show you just how to do that. Head on over to 5stepretirementplan.com to learn how to create your retirement master plan. That's 5stepretirementplan.com. You can use the number or spell it out. You'll get there either way. Head over to 5stepretirementplan.com. Thanks for listening, and now for the rest of the show. Now you're thinking through, okay, how do I decide how much to put in there? It's all about how much safety you want to have. If you're a little bit more on the aggressive side, you might say, I want next month's money. I want to know I got next month's money set aside, or next year's money, or the next couple years worth of money. You'd have a shorter amount of cash flows that you've projected out. You need, say, 50 grand a year for 1 or 2 years. You've said, I'm going to have a shorter number of those years cash flows set aside in my income bucket. Or maybe you're more conservative and you want a larger amount of cash flows set aside in your income bucket. You want 3 years, 5 years, 7 years, 10 years, whatever the number is that's right for you in the short-term income bucket. That's what you want to have set aside. And I've got a cash flow chart. Let me find it here. There we go. Page 113 in chapter 9 and the book Retire Today. It goes through and shows you this timeline, how you want to project out first. What do you need for cash flows? That's why the first step is spending. Next, you want to see what other cash flows are coming in from Social Security. That's why step 2 is the world of how much do you make in retirement. And then project it out. How long of time frame do you want to plan for? Set that money aside in your short-term income bucket. Well, then how much do you put in your long-term growth bucket? Well, the answer is everything else. If it's not short-term money, it's long-term money. So you might have thought, okay, I get to retirement investing. And this is going to be this complex financial modeling. It's really not. It's really 5 things you do. You figure out, number 1, how much money do you need in the short term? All right, you've mapped it out. I'll put this cash flow timeline in the show notes for you. You've mapped it out. How much money do I need in the short term? Well, step 2, set that money aside in short-term investments. Find the bank type accounts, the money markets, maybe short-term bonds if you want to take on a little bit of risk, a little bit of fluctuations. It's not guaranteed to pay back to you. Well, then step 3, everything else is long-term. And if it's long-term money, you should feel comfortable putting that money into long-term types of investments, the stocks and bonds, the mutual funds, the things you're maybe kind of used to. And when you invest that money, you want to base that. How much do you put into the stock market? It's based on a level of ups and downs. Good fancy word for that is volatility. It's based on how much ups and downs, volatility you're willing to take. Quick rubric for you, a quick way to figure this out is think of, okay, the money you have invested in the long run. On a scale of 1 to 10, how much risk are you willing to take into the stock market? If the answer is 10 out of 10, if the answer is 5 out of 10, I'm willing to put 5 out of 10 on my risk scale here into the stock market. We'll just add a 0. You're willing to put, say, 50% or 100% into the stock market. Depends on your thoughts on the scale of 1 to 10 for how much risk you want to take into the stock market. Now, that's not exact science, but it's a good starting point. It gets you most of the way there. So now you've figured out how much you need in the short term, step 1. You have set aside your money in short-term investments, step 2. You know that the rest of your money is in long-term, and you have invested that based on a level of risk you're willing to invest in the long run. That's step 3. Well, you're not done. You're not retired once. I think a problem with retirement investing, I was just interviewed on a podcast, the Stacking Benjamins podcast earlier today. And we were talking about that a lot of people, the big problem with something like the 4% rule, as an example, is you feel like I hit retirement, I got my rule, and I'm done. No, it's not done. Your investment needs change over time. Your cash flow needs change over time. That's specifically on page 113 of the book. What I'm showing is how your cash flow timeline changes, where as you move through retirement, you're getting closer to a way where maybe some of your Social Security kicks in, or your needs for money change, right? Things change over time. So as you are then investing, you start out, you got your short-term money, your long-term money. Periodically, perhaps once a year, you look at your growth bucket, the money you put into the stock market, the bond market, you set it as a certain percentage. That changed almost instantly. The day that you put the money in, the market moves things around. You need to rebalance your growth money to make sure you have the right level of risk. I got this other chart in the book. There it is, page 11, how it talks about rebalancing your growth bucket. If you had invested on January 1 of 2020, just a 60-40 portfolio, 2 years later, January 1, 2022, and you hadn't touched that money at all, maybe you're getting ready for retirement, and you just put 60% in stocks, 40% in bonds. 2 years later, your stock percentage, I was just using the S&P 500, the bond index that's out there, your stock percentage would have gone up to 68%. You had signed up for a certain level of risk, and 2 years later, you had more risk than you signed up for. That's why you rebalance your growth bucket. The opposite could happen. Maybe the market goes down and you have less risk than you signed up for. Well, if you're planning on investing this money for the long run and you have less risk than you expected, usually less risk equates long term with less return. So you want to rebalance your growth bucket periodically. You also want to take a look here and say, wait a second, I got this growth bucket money. I got the income bucket money. You're taking money out of the income bucket. Your income bucket's getting smaller. Every so often, you will be taking money from the growth bucket, moving it over to the income bucket so that you've got that money filled back up. Hopefully you've done it after the market's up. Hopefully you've done it at a profit. But if you're looking at this on an ongoing basis, you are saying, I want to solve for number one, how much spending do I need to take out of my investments? And then how long of a time frame do I want to plan for? That's my short-term bucket, my short-term income money. And then the money in the long-term growth, it's there to grow for the future. But the future comes, now it's short-term, you're taking that money out. So you want to rebalance, refill that income bucket earlier. Now, I said earlier that the number one retirement mistake that I see people make all the time is they're trying to control what they can't control. You can't control the stock market. You can't control the U.S. economy. You can't control the next election, but you can control these other areas that you ought to be looking at first. You can control your spending, what you do with your Social Security, what you do with your tax planning. You can control how much money you take out of the stock market. You can control how much risk up and down you take in the market. You can control whether you're diversified within the market, if you're actually rebalancing your growth bucket between the stocks and bonds, if you're refilling your income bucket from that growth bucket at the right time. Those are the things you can't control. You want to focus on the things you can control, which includes the fifth and final step in the retirement master plan, planning for what you leave behind. I'll be covering that next week. This is step 4 of the 5-step process to create your retirement master plan, all found in my book, Retire Today. Head on over to jeremykeil.com for a link to buy the book, JEREMYKEIL.com for a link to buy the book, Retire Today. Thank you for listening to the Retire Today podcast. We believe if you know more about your money, you will feel better about your money and you will make better money decisions. Hi, I'm Jeremy Keil. If you'd like to learn how my team can help you get more income, pay less in taxes, and avoid big retirement mistakes, head on over to keilfp.com. That's KEILFP.com.